Alexis? Colin? Marcus? Allie? Evan? Kristen? Brennan? Greg? Jake? Eric? Sue? Maddie? Jessica? Brian? Hallie? Malik? Samantha? Haley? Chad? Nicole? Sarah? Hi. Jacob? Andrew. Okay. Okay, so I'm trying a couple of things with the lecture capture. For those of you that were not here on Friday, this might be of interest to you, so listen up. I recorded the lecture on Friday. I'm uploading it. I had to create a YouTube channel and do all these things I didn't know how to do, so I'm working on getting that into Blackboard today. So if you miss a class due to a sporting event or perhaps an illness or you're just sleeping, you can watch the video later on. But I'm playing around with the layout a little bit because I can sort of adjust it to see just the screen, the whiteboard and the screen, and since we use both, I'm trying to figure out what's going to work best for me. So I should have that video from Friday uploaded today into Blackboard. So for those of you that were not here, we started chapter 2. And today we're going to continue with our conversation there. Don't forget, homework was due today. If you're still having trouble with that or you forgot, I see a couple surprise looks or something, please let me know and see me after class, and we'll get you situated there. Okay, so we started to talk about accounts. We talked about some more terminology, very heavy in the terminology for the first couple of chapters. I explained to you that we're making a transition from the way we did things in chapter 1 to a more formal approach in chapter 2, where you're actually going to be learning about the documents and the forms that real accountants use in the office. And so we're going from that format in chapter 1, bless you, where we had our columns, right? Where we did assets equal liabilities plus equity, and this should look familiar, I hope. We just got done doing some graded homework, right? And we had cash and accounts receivable and supplies, perhaps. And then on the right, we had accounts payable, and we had common stock and dividends and revenues and expenses. And then we listed our transactions, right? All the way through, and at the very bottom, we had a balance. So the reason I jot this down for you is because this really achieved two things for us, right? It identified the individual amounts of each transaction, so we knew each transaction and the amount, right? We did this the other day, just to review here real quick. And then we knew the balances of each account after every transaction, okay? So that's an easy way of learning how to record and report, but it's not very efficient. So we said, lots of companies have, we only have a few accounts here, but a lot of companies have hundreds of accounts or thousands of accounts. Well, we're not going to be able to fit that across our paper. We only have so much space on our paper. So this is going to be replaced in chapter 2 by 2 official records or documents that real accountants actually use. And one is the journal, and the other is the ledger. So this is what we discussed on Fridays. Everybody that was here remember that? Does that sound familiar, hopefully? Okay, good. All right. So who can tell me what the journal was? Give me the definition of the journal. What did we say the journal was for?
Record the transaction and the amount.
We're going to record the transaction and the amount in the journal, okay? And then the ledger, what did we say the ledger was for?
Record the balance.
Okay, yeah, we keep track and record the balances of each account. Now, I didn't actually get a chance to show you what each of those looked like formally, because we had to talk a little bit about this thing called a T account first, okay? And this is kind of where we left off. So we talked about the chart of accounts as well. Who remembers what the chart of accounts is. Or a definition of the chart of accounts. The accounts, yep. It's a list of all of our accounts, and what do they have attached to them? A number, right, an account number, right? And the account number, we said, was to help us to sort of keep things organized, right? And any account number that began with the number 1 represents what? Assets, yes, represents assets. Any account number that begins with a 2? Liabilities. 3? Equity, and specifically, we have common stock and dividends, right? What about 4? Revenues. And 5? It's nothing yet, right? That's coming up in chapter 4. Okay, and 6? Expenses. There we go. Okay. So we talked about that as well. So that's kind of like our word bank that we have to pick from. So when we're recording transactions, so that we know, it helps us kind of decide which account are we going to need to change in order to reflect these activities or these events that are taking place in our business, okay? So we've been talking about recording business transactions. We haven't even mentioned the words debits and credits until this chapter. So debits and credits are going to be replacement words for what 2 terms? We talked about that on Friday as well. What are we going to use debits and credits to replace? No? Increases and decreases, right. So debits and credits are accounting terms that will be used to replace the terms increase and decrease, right? All right, those are official accounting language, okay? So we want to use official accounting language. So instead of saying increase or decrease, we're going to say debit or credit. But we need to know when to insert or when to use the words debits and credits. And there are rules that go along with that. And that's one of the things you're going to learn about today, okay? In the meantime, we're going to talk about a T account. A T account is sort of like a shortcut for accountants. I'll call it a shortcut for accountants. It's going to actually allow us to sort of do what we did in chapter 1 when we're kind of trying to figure out something kind of quickly, or we don't have formal records in front of us that we want to use. But a T account has several characteristics. Each of these accounts that we saw in chapter 1 are going to be represented by the letter T. And there's some characteristics that go along with this. We have the left side, which you can see up there, which you don't really need to write down again, but, and that makes sense. The right side of the T, the left side of the T, okay? In order for us to understand the rules of debits and credits, you first have to know which side represents each word. The left side of an account, we always refer to as the debit side. The right side of an account, we refer to as the credit side. Now again, you don't know what they mean yet, but I'm going to tell you here momentarily what they mean. So that means, for example, that each of these accounts from chapter 1, and I'll just throw a few of them up here so you get the idea here. We're transitioning, remember? So for example, cash. It's going to look like that, okay? And the left side is going to be the debit side, and the right side is going to be the credit side. I'm just going to throw a couple examples up here. Accounts payable. Every single account that we're going to use to record our business transactions is going to have a T that represents what goes on in that account, okay? I'll do a couple more here. All right, so every single account that we're going to be using to record business transactions is going to be represented by a T. It's kind of a shortcut for us. The left side is the debit side, the right side is the credit side. Okay, it'll start to make sense, I promise. Okay, these are what we call the rules of debits and credits. Okay, these are the rules. And this is that translation that I was just talking about. We're going to replace the words increase and decrease with debits and credits. Okay? Now the thing about the rules is that they don't make a lot of sense to students at first, and they shouldn't. It's totally normal. But you have to memorize them. And I don't like to tell you to memorize anything, because what we do is we memorize things for a test or for a short period of time and then we forget about them. But really in the beginning you have to kind of memorize these, or you have to have them on a note card or a scrap piece of paper. You have to have them in front of you until they just become the thing that you do. And they will become the thing that you do. But initially they're kind of hard to grasp, but eventually I promise you, you're going to get it. So we're still looking at that accounting equation. Assets equal liabilities plus equity. Okay, and we're going to look at the expanded version of equity here momentarily. But every asset account is going to be represented by this T account. And that's just to tell us what we do with the account when we're recording a business transaction. So these rules tell me when I replace the words increase and decrease with the words debits and credits. Okay, these are the rules. So a couple of things about debits and credits. We actually abbreviate debit DR and credit CR. Now you'll see that there's actually no R in the word debit, but there was in the original Latin form of the word. It was debitere, D-E-B-I-T-E-R-E. So when we abbreviate debit and credit, we abbreviate them DR and CR, and that's perfectly acceptable. You do not have to write the words out every time, okay? So we talk about these rules. We start out with the basic accounting equation. And remember, the accounting equation is that underlying theory that tells us that we have to have at least two accounts affected by every business activity or transaction. And that's why it's called a double entry system, at least two, right? Double meaning two, okay? So anytime we have one, we have to have another one. And ultimately our goal is to have the left side equal the right side. Still our goal, same as our goal was in chapter 1. You're not really learning anything new as far as how to record or how to report. We're just now incorporating that accounting lingo into what we've done so far, okay? Lots of different industries have certain terms that are specific to that industry, right? Andrew, what did you just got your real estate license, right? Aren't there specific terms or terminology that are associated with that industry specifically, right? That you wouldn't use in some other, in some other job. So it's just specific to the field of accounting. All right, so these rules are this. Every account has an increase side and a decrease side, okay? When we want to increase an asset, so I erased it over here, but in our column format, when I gave cash to the business, we said plus 10,000, right? I mean, cash increased. Now when we want to increase cash or any other assets, we are going to say we debit cash, we debit accounts receivable, we debit supplies. So instead of saying we increase, we translate that into debit or credit. In this case, it's a debit. Anytime we want to decrease an asset, such as cash. So if we pay our rent, we pay employees, we pay our liability, we pay off our credit card bill. Instead of saying cash decreased, we're going to say we credit cash. So really it's just a matter of changing the terminology a little bit, okay? Now, this equal sign is very important right here. This is on the left. This is on the opposite side, right, of the sign. So if it's on the opposite side, these signs are going to be opposite or flipped. So if you want to increase a liability, let's say that I buy a piece of equipment and I don't pay for it. Remember how our notes payable increased? Instead of saying we're going to increase notes payable, we're going to say we're going to credit notes payable. When I pay off the note payable, we said we decreased notes payable. Now we're going to say we debited notes payable. It's definitely hard to get used to, but I promise you will. And because this is on the same side as this, generally speaking, this is the same, okay? So you'll see here, and they've had some arrows here. Obviously, increase, decrease, right? Decrease, increase, decrease, increase. We're still going to rely on those terms, decrease and increase, to help us pick what term we should be using here, whether it's debit or credit, okay? So I'll explain that here in a minute, but we're not quite finished. Any questions so far? Okay, these are the rules. You kind of have to memorize them. So remember equity. Equity gets broken down into 4 components, right? Kind of been talking about that enough I feel pretty good that you know that at this point. All right, so we have common stock. We have dividends. We have revenues, and we have expenses. And these are all categories, right, of accounts that we need to use in order to record the events of the transactions that take place in our business that affect our financial position. The rules, we all start out, again, the left side is always the debit side, the right side is always the credit side. Okay? So when we're thinking of these 4 individual components of equity, think about what effect they have on equity, and that will help you with the rules. Okay? So, the normal signs for equity, a debit is a decrease and a credit is an increase. What 2 accounts also increase equity of my 4 down here? Yes, common stock and revenues. Both increase equity. Very good. So they will have the same signs as equity. So common stock and revenues both decrease with the debit and increase with the credit. Okay? Dividends and expenses reduce equity, right? Where they have the opposite effects. So what do you suppose their signs are? Plus, minus. Exactly. So dividends and expenses increase with the debit. So anytime you incur an expense, remember how we were adding them up and then subtracting them off at the end? That's really all we're doing. These accounts are going to allow us to accumulate the balances that we need. And again, these are a shortcut version of something that I haven't shown you just yet, but they are a shortcut version of something. So before we see all those other forms and where we actually will achieve number 1 and number 2, the journal and the ledger, where we're going to record and keep track of our balances, we need to know these rules. So this up here, right here in the center, this rule, you have to memorize. These rules, you have to memorize. I'm going to give you a quiz on Wednesday to see if you know these rules. Basically, the quiz is going to be very simple. You're going to put the pluses and the minuses where they go. That's going to be your quiz, okay? I need to know that you know these. If that means, taking a note card and writing them down, do that, whatever it takes, whatever you have to do, but you have to know them, all right? Make it easy for yourself, all right? Use some logic when you're trying to remember them. And here's what I'm referring to. Look up here. Start out with assets, Know that one. If you know assets, then here's what you can make certain assumptions. These 2 are on the opposite side of the equal sign, so therefore they have to be the opposite of assets. So if you know assets, you know that to the right, you flip them, right? When you look at the breakdown of equity, pick the 2 accounts that increase equity and tell yourself, okay, they increase equity, so they have to have the same signs as the equity account, right? The other 2 have the opposite effect on equity. They reduce equity, so their signs have to be flipped. And practice writing those out so that you know them. Okay? Now, what do we do with these? Good question. This is an example of some of the transactions that we saw in our column format, now looking at this in form of a T. So let me go back to that column format. So again, I'd like you to understand the transition from chapter 1 to chapter 2. Okay? So again, in chapter 1, and I'm only going to put cash up here since that's what we're looking at. We had assets equal liabilities plus equity, and then we had certain components, and we had cash, right? And then we had other things here, but we had cash. So in chapter 1, when we had an investment by the owner for stock, right? We said, okay, transaction A plus 30,000. Right? Okay, now in chapter 2, left side is always the debit side, right side is always the credit side. The signs go like that for cash because cash is an asset. So now we have to start to remember, okay, what classification is our account? You have to know that cash is an asset. If you don't know cash is an asset, then you don't know what the sign is. So there's a couple of things going on here. We've got to know our classifications: asset, liability, equity, revenue, expense. We have to know examples of each of those, and then we have to know the rules that go along with them, all right? So, in my new system, if I'm using the T account, this plus 30,000, if I'm transitioning from chapter 1 to chapter 2, this plus 30,000 goes where? On this side, right? And obviously it's up there for you, right? Now there's another half to that, but I'm not going to worry about the other half of it right now. I just want to show you how this column now looks like this. We're replacing the column with the T, okay? And we can, I don't really know specifically what order these went in, but I'll go across here. Purchase of supplies. What happens when we buy supplies? What happens to our cash? It decreased. So how do we decrease cash? With a credit, right? In chapter 1, we did this. And then after that, we balanced, correct? Right? Okay. Over here, we make the entry. We're not going to balance just yet, but you see where I'm getting at with this? So this column format is now being replaced by this T. Well, you can see that after all of the entries are in the T, and over here, payment of rent, perhaps, I'm not going to go the whole way here, but payment of rent, and then we had a balance for 26.5. Eventually, at the very bottom, our final balance would have been $4,800. And again, you guys had enough practice with that column that I think you know what I mean. Okay? Over here, and again, since it's up here, I'm not going to keep writing. But over here, we end up with the same balance, but here's how. When you want to increase cash, you put it in the debit side. When you want to decrease cash, you put it in the credit side, because that's what the rules tell us. When you're all done with transactions, you're all done with the recording part, remember, our goal is to then eventually report. In order to report, I need a balance of every account. So my column, I waited till the very bottom and I used that number. In my T account, what I do is I add up everything on the left. So notice here, the total increase is 30,000, 4,200, 1,900, 36,100. I add up everything on the right, and in this case, it would be all my decreases, right? Add them all up, they add to 31,300. Well, 36,100 is greater than 31,300, correct? So you take the side with the greater value, and you subtract the side with the lower value. That's all. 36,100 minus 31,300. Okay? Your end result is a balance of 4,800. The balance gets put in the side where the number is the highest. Right? So this 4,800 represents a positive balance. Isn't that what I'd like to have in my cash? A plus, a positive number, right? We call the plus side of any account its normal balance. So the plus side of any account is called the normal balance, which means if I have a minus as a balance in my cash, what should you say to yourself? That's not normal. I made a mistake somewhere. That means you're overdrawn, right? You actually are negative cash. Do you want to be negative cash? No, and in this class, we're not going to be negative cash because everything always works out perfectly because, it's an introductory course. We're not going to have negative values that sort of throw us off. But if you have a negative number, you probably have an error somewhere. But the plus side of every account is its normal balance. And I use that term a lot, so you need to get accustomed to that. So if I say, what's the normal balance of an asset, you're going to tell me it's a debit. If I ask you, what's the normal balance of a liability, you would say a credit, right? If I ask you, what's the normal balance of a dividend, it's a debit. The normal balance of common stock is a credit. So that's another reason why you need to know where those pluses and those minuses go, because you need to know what the normal balance of certain accounts is. And that'll actually help us later on knowing the normal balance. So we've replaced this T, or we've replaced the column, with the T account. Okay? So transitioning into a more formal record. This is a shortcut of one of those formal records that we're going to look at. T accounts are shortcuts that all accountants use, but they do represent a formal computerized form, okay, that we're going to see here in a little bit. Any questions so far? Really haven't learned anything new. I'm simply just replacing some things from chapter 1 with some new ways of recording them or looking at them in chapter 2. If I were to ask you to record transactions that you did in chapter 1, you're still actually going to do them the same way, with a little bit of like a tweak there at the end. All right, which we're getting to here momentarily. Okay, so how does this all work now in chapter 2? Okay, well, in chapter 1, when we wanted to record business transactions, we actually did some steps, even though I didn't say, okay, this is step 1, this is step 2. We kind of did that. In chapter 1, step 1 was to analyze and identify. And I'll just say identify, I can't spell, identify the accounts that are affected by the business transaction. So we can use any example that you've had in all of the ones that you've recorded so far. When the owner gave money to the business, what were the 2 accounts that were affected by the transaction or the event? When the owner gives business, what 2 accounts did we change? When the owner gave money to the business, what were they? Cash? Yes, cash and common stock. That was step 1. That's what we did in chapter 1. That's what we did, right? Okay. Step 2 then, in chapter 1, we simply decided whether those accounts increased or decreased. So in that case, we said cash increased, right? So we put a plus, whatever the number was underneath cash. We'd go over to common stock, and common stock also increased, right? And we'd say, okay, common stock increased. That's what we did in chapter 1. The only thing we're adding from chapter 2 is one more step. Okay, we're going to do the exact same 2 steps in chapter 2, only once we decide whether those accounts increase or decrease, we're going to translate those increases and decreases into debits and credits. That's the only step we're adding. And for this step, you need your rules, right? That's why I gave you the rules. For this step, you need your rules. When we get to step 3, then, we're going to incorporate those formal records, which is what this slide is kind of showing us up here. Okay, so in this slide, analyze transactions and source documents. So in real life, somebody's not giving you a list of transactions that say the owner gave $84,000 to the business, the owner paid rent, the owner bought supplies, the owner did this, the owner did that. You have documents that come across your desk, or you receive them via email, right? Or somebody calls you up and says, I need you to do this. Those are the things that happen that allow you to identify what needs to get recorded, okay? But in any event, analyze transactions and source documents. Basically, that's what we do in step 1, okay? Step 2 says, look at the T account, right? Look at the T account. Decide which accounts are affected and determine whether they're going to increase or decrease. When we say apply double entry accounting, which I'm going to get to here in a minute, I need at least two accounts, right? So same rule as chapter 1. So I have to have at least one debit and at least one credit. My debits have to equal my credits in order for my accounting equation to stay in balance. My debits have to equal my credits. So every time I record a business transaction now, I have to have at least one of each, because I still need to stay in balance, right? I still need to stay in balance. And if you look at it this way, look, plus on the left, right? plus is on the right in order to stay in balance. Okay? A minus on the left, a minus on the right. The debits would be on the right, the credits would be on the left, but either way, they're equal. So my debits have to equal my credits. My debits have to equal my credits, so I have to have at least one of each. So when we're doing these transactions, we have to remember that, okay? The journal. Remember I said the journal was going to replace this column format here, okay? The journal is a place where we write down where the things happen in our business. So there's a little picture of it in the corner. It's not the greatest picture, but I might show you here a bigger version of that. Not that there's... That's my only option here. Okay, so in your book, and this is at the bottom of page, and it's going to be small, but I'll make it big here for you. A little tiny. Okay, so this is the bottom of page 63 or something like that, I think it is. This is an example of what a journal looks like, okay? And if you think about, again, we talk about writing a personal journal. It's just a blank line page, right? You just write in it. It's kind of the same idea. Now, a journal in accounting has a few more characteristics to it. So we call this the general journal because this is where we put the general or the daily business activities. I just usually refer to it as the journal. They mean the same thing, okay? Every journal starts out, now this is an electronic version of this. So any kind of accounting software that you use will have an electronic version. But back in the old days when I learned accounting, it was literally just sheets of paper that looked like that. You had to manually write everything out. In a computer now, you get to select things from drop-down lists just like Connect. Okay? It's a lot quicker, it's a lot easier. We used to have to spread out and have all kinds of sheets all over the desk and, you know. So, the left column is always the date column because we want to identify when the transaction took place. So just think of it as like, like in your checkbook register, you put the date of whatever in your deposit or your withdrawal. Okay, the date's important. It's a point of reference for when something occurred, because a lot of times people go back and say, okay, when was that? When did that happen? Right? And if you didn't write the date next to it, you don't know when it happened. So that's the first thing. You'll notice here at the top, we put the year 2013. You only have to write the year one time at the top of each page, unless the year changes in the middle of the page. So if this is transactions for December and we're moving on to January, obviously the year would change, and so you'd have to identify that when it happened, okay? Otherwise, you only need to write the year one time at the very top of the column, the date column. The next section identifies these two things right here. The accounts that have been affected by our business transaction. So our first transaction was always the owner gave money to the business. That's the easiest one. That's the one we're going to look at, okay? You'll notice that the word cash has been placed on the first line, and the word common stock has been placed on the second line, actually indented. And there's a reason for that, and I'll tell you why here in a second. All right, so here's where we identify what accounts have been affected by our transaction. So in our column format over here, right, we had common stock, and we did this. Right? Look familiar? Okay. All right. Underneath is a brief explanation of what happened. Receive investment by owner. Okay? We tend to use those explanations when we're learning how to do all this because it helps us. It's not necessary. Once you understand debits and credits, you won't need the explanation to tell you exactly what happened. There's another column here. It's initial PR. That's called posting reference. I'll talk about that a little later. That's going to be used for something else. Then notice, look, we have one debit column and one credit column. Okay? The reason we have one of each is because you have to have one of each if you want your equation to stay in balance. So you have to have a debit and a credit column. Okay? All right, now let's take a look up here. So in chapter 1, we said plus 30,000, plus 30,000. All right, now let's apply what we've just learned. So when the owner gives money to the business, cash increases, common stock increases. Go to your debit and credit rules. How do you increase cash? With a debit. How do you increase common stock? With a credit, right? So now instead of saying increase, we say we debit cash, We credit common stock. We always list the debit first. So notice, look, cash is written and 30,000 is placed in the debit column, right? The second line, and you only put one transaction or one account name and one number on each line. You don't ever write them side by side. On the next line down, you'll notice that the word common stock or the account common stock has been written. It is indented to show that it is a credit because the credit column is to the right of the debit column. If I wrote cash and common stock right underneath, I might have a difficult time figuring out which one's which. It's just to help the eye, it's just kind of train the eye that when you see something to the right, it's a credit because the credit column is over to the right. That's all it is. Then you'll notice that common stock is listed in the credit column. So that transaction has now replaced this right here. And if I have 500 transactions in a month, I just continue to list them one right after the other. Whereas my columns would have to get wider, and that's not going to work. This journal has an endless number of pages, especially if I'm looking at this in electronic view, right? I can just keep going on forever and ever and ever. My column format, I can't go any wider than your sheet of paper, in my case, the board, right? So this now has replaced how we did things in chapter 1. Same idea though. So you still have to decide what accounts are affected. You still have to decide whether they increase or decrease. You have to look at your rules and translate those increases and decreases into debits and credits. So do my debits equal my credits? 30,000 equals 30,000? Yes, they do. I can move on to the next transaction. Remember, the journal is just the place where I'm recording what has happened. No balances in this journal. In other words, if I have 20 transactions that affect cash, I'm not going to know the balance of my cash by looking at this journal. I got to look at something else later. This is the journal, okay? Take the next one, over here. We bought supplies, okay, for $2,500. And so if I had supplies up here, I did this. You guys remember that? We exchanged one asset for another, correct? Okay. So if you think about that, if I bought supplies with cash, the two accounts that are affected, we're going to just apply what we learned in chapter 1. The two accounts that are affected are cash and supplies. What happens to cash and supplies? Well, if I buy supplies, my cash is going down, right? And if I'm buying supplies, I'm getting supplies, so my supplies should go up. Well, they're both assets, right? Cash and supplies are both assets. So let's talk about supplies. Supplies is the asset that I'm receiving, so it's going to increase. How do I increase an asset? With the debit. So look, in second transaction, we debit supplies in the debit column for $2,500. We use cash to pay for those supplies, so cash should go down. We decrease cash with a credit. So next line, I write the word cash, I indent it to indicate it is my credit, and I place the $2,500 in my credit column. Not learning anything new as far as how to record transactions, you're just putting them in the proper place now, which is the journal. Questions so far? A little bit overwhelming sometimes making that transition, but again, if you think about what we did in chapter 1, we've really only added a little bit of another component to it, where we're taking decreases and increases and saying, okay, let's use real accounting terms now, debits and credits. Okay. Questions? You'll get plenty of practice, I promise. Okay. The fourth step. Once we put all of our journal entries, or record all of our entries in the journal, here's another picture of the journal, and you'll notice it's page, look at this, page 123. See, we could go on forever, right? Week after week after week, transaction after transaction, we can have as many pages as we need, right? That's just, however, the place where we write down what happened. It does not reflect the balances. The balances get reflected in something called the ledger. So step 4, we translated those increases and decreases into debits and credits and recorded them in the journal. Let me add that here. Okay. Step 4 is simply to post the journal entries to the ledger. All right, now, what I was saying earlier, the ledger, this T account right here, this T, any T account, is a shortcut to this thing we call ledger. The ledger kind of looks like a checkbook register. Does everybody know what one of those looks like? You know, like the little top part of, yeah, okay, where you write everything down. You know, you write down the date, who you wrote the check to, you deduct it from your balance, where you keep track of everything. Every single account in our chart of accounts has a ledger. Its very own checkbook register, I like to call it. The reason that every single account has its own ledger or checkbook register is because we have to keep track of all of the balances in every account that we use to record our events and transactions. If you have 400 accounts, how many individual ledgers do you think you need? If I have 400 accounts, how many ledgers should I have? 400, one for every single account. If I have 67 asset accounts, cash, accounts receivable, and 65 more, I need to have 65 of these, or 67 of these. I need one for every single account that I have, because this is where you're going to see the balance of each account in our chart of accounts. Once I make the entry in the journal, I have to transfer the information. Transfer the information from here to here. This is not fun to draw, this right here. In electronic form, it's lovely. It is, okay? To draw that on the board for every single account I need, not happening. The T account is my shortcut for that. And here's how. Let me see if I have a better one here we can look at. No, let's just take a look at this one for now. All right, so see where it says account name. Again, think of this like your checkbook register. You got the account name, so cash, okay? Account number, that comes from that chart of accounts, the account number. Each account's going to have one of those. See, as much as I don't like to do that, like to do this, I probably will draw one up here just for the sake of showing you that I can't draw. And that would not be fun to draw that every single time. So, you know, we've got the account, okay, and we'll do cash for this one, all right? And then we have the account number, and we'll just say 101. Doesn't really matter, as long as it starts with what number? 1, because it is an asset, right, okay. So, we have the date, okay, and in my example, we'll just say December 1st. I think that's what it was anyway in the previous one. And then we have a description. Now, what is the description for? Well, the description can be for a lot of different things. Typically, since this is the cash account, I don't need to write cash. I know that it's the cash account. But this, I can identify exactly what happened to my cash. So this was investment by owner. Okay? You'll see that there's another column there, PR. I'm going to get to that in a minute. All right? And then debit, credit, and balance. And again, doesn't this look just like your checkbook register? I mean, pretty close, right? All right. So, okay. This first transaction in the journal, I'll put that back up here too. All right, if this is the journal, and I'm going to skip a lot of the details here, you'll get the gist. This is my journal. This is what I did. I debited cash for $30,000, and I credited common stock for $30,000 without drawing all the lines and the titles. That looks like what we just looked at, right? Once I do this, okay, and again, I'm just recording all the things that happened. This does not reflect balances. I have to transfer this over to here. So I would have one for cash, and I'd also have another one for common stock. The word post means to transfer. The word post means to transfer. So let's take a look at this cash. What did I do to cash? This was a debit, right? Okay. Since I debited cash in my journal, I transfer it to the ledger exactly the same way. I debit $30,000. Okay? My cash had nothing in it before. Now it has an entry for 30,000, so what's the balance? I almost forgot that column. 30,000, right? Just like your checkbook register would look. This PR stands for post reference. Post reference. In other words, where did you get that number? Where did you transfer that number from? This particular journal is page 123, so I'll leave it at that. This is page 123. This is where I'm getting it from, page 123. So you can do a couple of different things here. You can do G123, which stands for General Journal, page 123. You can do GJ, General Journal. You can do J. I don't care. What I'm looking for here is this, because that tells me what page number the entry came from. I got 123 pages of journal entries. If I have to go find one, do you want to flip through 123 pages to locate the one you're looking for? Probably not. So if you tell me what page number it's on and there's a problem, I can go directly to that page number and find it. So this tells me where this number came from. It came from the journal, page 123. Over here, and I didn't do a great job of leaving any kind of space here, but there is another space in here, okay? This posting reference right here, this posting reference on here tells me where I put the cash. I put it in account number 101. So what I want to see there is the account number 101. Cross-referenced, right? I can look at either document and I know where the number went to and I know where it came from. So you've got a cross-reference there. They're connected now. All right, now, the second transaction, look, old way, chapter 1, we debited supplies. And we credited cash. Remember? Okay, running out of time here, almost done. Now, I'm not worrying about common stock and supplies for now, I'm just focusing on cash so you can see how this works. But each of these would also have one of these accounts. So what did I do to cash? I credited cash, right? So let's pretend this is December 2nd, purchased supplies. Doesn't this look like your checkbook register, folks? Right? Every account, though, has to have one. Where did it come from? Same page. I'm still on the same page. But look, I credited cash for $2,500. So look, think about this. If my cash had a balance of $30,000 and I bought something for $2,500, what's my balance after? And so those two combined, the journal and the ledger, now replace this column format we used in chapter 1. The T account, watch very carefully. You want to see where the T account comes from? I don't want to draw this for every single account I have. I can draw 15 T's in about 10 seconds. This would take me forever to draw 15 of these. There's my T right there. So it's just a shortcut. I'm grabbing out of that ledger just what I need to get the numbers that I need and to come up with a balance if I need to very quickly. That's where the T comes from. Everybody sees the T, right? Just the main component of the ledger. All right, so no homework for right now. Start looking at your Learn Smart. Review what we did today, please. And study your debit and credit rules. You have a quiz on Wednesday. First thing we'll do Wednesday morning is take the quiz.